So we'll start our journey through the income protection insurance section by getting a general overview as to what income protection is all about. So essentially these are long-term policies which are designed to pay a regular income when the insured becomes unable to work due to long-term illness or general incapacity. And they started their life being referred to as permanent health insurance, PHI policies, because of the fact that once these policies start, provided you continue your premiums, then it cannot be cancelled by the insurer. Hence the name permanent health insurance. So you see these names interchangeable really, but for the ease of understanding, we'll talk about income protection policies throughout. So once in force, these policies cannot be cancelled by the insurer, provided you keep your premiums maintained and provided, of course, that you met all conditions that are stipulated in the policy. The insurer cannot increase the premiums due to claim history, change in personal circumstances. Once it's accepted, it's pretty much going to remain until expiry, assuming, of course, that you keep your side of the bargain. So why would we need an income protection policy? Well, essentially this is to protect against you losing your income and having no earnings and essentially being unable to pay your bills. That's essentially what it's covering. So it needs to kick in, this sort of insurance, when your employer support ceases. So generally speaking, you would dovetail this into the amount of time that you're paid when you're off work sick. Or for self-employed individuals, after a period that perhaps you can self-insure, would be when it needs to start. You can also provide financial support for people that are homemakers, housepersons, albeit that's a very small part of the process that we'll only look at very briefly as we go through this. So generally speaking, the whole idea is to provide cover that is paid to you on an ongoing basis, and the cover that you require is going to be very much bespoke to your individual circumstances. So your income levels, your own expenditure levels, the time when cover needs to start, whether that be to link in with employer or your own savings, and even what occupation you do and what hazardous pursuits, if any, that you get up to. So all in all, these sorts of things can have an impact on the ability to get insured, the need for insurance, and also the premiums that you're likely to pay. So it's intended to replace lost income, not to increase your income. And I think it's important to appreciate right at the start that you cannot use an income protection policy essentially to be rich whilst incapacitated. In other words, you can't claim on these while still being paid from an employer. So there are various different policy types that you can take out for income protection. That the strategies that you'll employ really. The standard policies, which we'll spend most of our time talking about. We've got limited term policies, day one and back to day one policies, investment linked policies, and unemployment policies. So generally at the left hand side, as we look at this, is what we're most likely to encounter and discuss over the course of the next few slides. So under a standard policy designed to, of course, replace income as we now know, it pays out after an agreed deferral period. In other words, there's a waiting period before you can start to claim. And it will continue then to pay until you return to work, you're deaf, or the policy expires. So these can pay for quite a long period of time. The benefits are usually arranged on a percentage of your income basis, e.g. 60%. And because of the way that they actually would ordinarily, individual policies this is, pay you the benefits, typically you'll be limited because of the fact that the benefits are paid tax-free rather than being paid taxable. So it's quite common to see caps on the maximum amount that you can actually insure yourself for, something we'll look at in more detail shortly. So normally you'd arrange these till state retirement age or before, if the plans is for you to not work that long. So limited term policies are essentially, as the name might suggest, policies that are set up for a set period of time, i.e. 5 years, significantly cheaper to standard policies, significantly rarer also than standard policies. And we've also got day one and back to day one policies, which are really designed for the self-employed. Benefits that begin immediately, day one, or backdated to day one after a specified qualification period. In other words, you might have a 3 month back to day one policy. If you're off work for 3 months, then it will that's your deferment period, but it will backdate all of your payments back to the first day of your incapacitated. So that's day one and back to day one. Investment linked policies, very rare these that you see these. Essentially, these are policies that got an element of endowment sort of feel to them, but the benefits aren't life cover, the benefits are incapacity benefits. And unemployment policies, which are really, really uncommon in the broader sense of the word now. You can add these to some policies. It's unusual though for an income protection plan that you'll be able to do that. So lots of different options, but we're going to mainly focus on the standard policy and all the internal features of that one, which we've now overviewed. There are group policies available, group income protection policies, which employers can provide to employees. And often these will have a 26-week deferment period to broadly align to the payment of statutory sick pay. They are generally provided on a free cover basis, which we've looked at a couple of times now, and this is generally free from underwriting as opposed to free from cost. If provided by an employer for an employee, it is not a benefit in kind to employees, and the reason for that is the benefits are paid to the company, and then generally they'll pay you your salary, so you'll pay tax and national insurance on your continuing income, generally speaking. So not to be confused with executive income protection plans, but they have elements like that where essentially the benefit in the first instance is paid to your company, and your company then continues to pay you your wages.